Let's be real. Managing your money these days, it feels like a constant balancing act, right? On one side, you've got debt, and on the other, the chance to build some real wealth. In this explainer, we're going to lay out a map for that journey, starting with a financial hurdle that's about to get a whole lot higher for millions of people. So you did it. You walked across that stage, got the degree. It's a huge accomplishment. But for millions of people, what comes right after that celebration is the heavy reality of student loans. And for many of them, that reality is about to change in a big way. Okay, look at this number, $3,500. Now, for the average person on the Save Student Loan Plan, this isn't some kind of bonus, no way. This is the potential extra interest they could be on the hook for every single year. So how on earth do we get to a number like that? All right, so here's the deal. It all comes down to a big policy shift. That interest-free period for the almost 8 million people on the Save plan, it's ending. So even if your monthly bill says zero, interest is going to start piling up again automatically. And that's a huge financial weight for millions of people. But look, tackling debt, that's just playing defense. If you really want to win the game, you got to play offense, right? And that means actively building your wealth through investing. So let's explore that path forward, starting with the very first big decision every investor has to make: individual stocks or funds. And this right here, this is the question that just freezes so many people in their tracks. You decide you want to invest, and then where do you even start? The whole world of investing seems so complex, full of jargon, and just endless choices. But honestly, for most of us, it really just boils down to two main starting points. This slide just lays out the fundamental choice perfectly. On one side, you have individual stocks. Think of it like betting on a single racehorse. The potential payoff? It could be huge. But the risk if that one horse stumbles? Also huge. Now, on the other side, you've got index funds or ETFs. This is like betting a tiny bit on all the horses in the race. You instantly own little pieces of hundreds of companies, so you're spreading that risk way, way out. And that right there is exactly why, for the vast majority of people, especially if you're just getting your feet wet, financial experts are pretty much all pointing in the same direction: diversification. Owning a piece of the whole market through a low-cost index fund is considered the simplest and most reliable path to long-term growth. It's the foundation of a solid strategy. But hey, let's say you're intrigued by individual stocks. You want to understand how to actually evaluate a company on your own. Well, to do that, you need the right tools. So we're going to crack open the toolkit, decode some of that Wall Street lingo, and give you a few simple but really powerful tools. Okay, first tool up, the PEG ratio. Don't let the name scare you off. All it does is answer one simple question: is this stock a good deal compared to how fast it's expected to grow? And the magic number you're looking for is 1. If you see a PEG ratio under 1, that's like a green flag for a lot of investors, kind of like a sign that a stock might be on sale. Okay, let's see this thing in the wild. Here are 3 companies you probably know: PayPal, Pinterest, and Micron. They're all projected to have some really strong earnings growth. But, and this is the key part, their PEG ratios are all well under that magic number of 1. That's what signals to some analysts that, hey, these might be trading at a bargain right now. All right, tool number 2 is all about looking at risk. It's the debt-to-equity ratio, or DE ratio. Think of it this way. If the PEG ratio tells you about a company's potential upside, the DE ratio gives you a clue about its stability. It basically shows you how much the company relies on borrowed money versus its own cash to run the show. Now, hold on, because this is super important. You can't just look at this number and say high is bad, low is good. It's not that simple. A high DE ratio could mean a company is taking on way too much risk. Or it could mean it's being super aggressive and using that debt to grow like crazy. A low ratio, yeah, that usually suggests it's more stable. So the absolute key here is context. A tech startup and a big old utility company are going to have totally different normal DE ratios. You always have to compare a company to its direct competitors in the same industry. Okay, so we've got a couple of tools for looking at individual companies. But here's the thing. Sometimes the biggest, scariest risks aren't hiding on one company's balance sheet. To really get what's going on, you have to zoom out and look at the whole system. And that brings us to, well, a bit of a cautionary tale. You know, the most dangerous risks are almost always the ones you can't see. They're not about one stock having a bad quarter. They're hidden deep inside these complex financial products that connect everything and everyone, creating this fragile web that can bring the whole system down. So this right here, this is one of those products, a mortgage-backed security, or MBS. The idea sounds pretty simple at first. Step 1. You take thousands of regular home mortgages and just bundle them all together into one giant pool, okay? Then, step 2, you slice up that pool into new investments. They call them tranches. Each slice has a different level of risk and, a different potential reward. And then these slices get sold off to investors all over the world. Okay, now look at this chart. In the years leading up to 2008, the creation of these things just went into absolute hyperdrive. I mean, we're talking about an explosion from about $100 billion a year to over $2 trillion. The entire system was just flooded with these incredibly complex and, as it turns out, incredibly risky assets. And yeah, we all know what happened next. The 2008 crisis was just this brutal, painful lesson that you can't just put your head down and analyze one stock. You have to understand the systemic risks, the big picture stuff, because that's where the real earthquakes happen. And that risk, it didn't just vanish. It just changes its shape. So after all that, what does this actually mean for you? Well, it means that getting a handle on this world, from your own student loan debt all the way up to the wild complexities of the global market, it's not just some homework assignment. It's about turning knowledge into real-world opportunity. All right, let's nail down the key takeaways from this journey. First, deal with your debt for sure, but never lose focus on building assets. Second, for most of us, diversification is the safest, most reliable path to long-term growth. It's your foundation. Third, if you do want to pick individual stocks, simple tools like the PEG and DE ratios can help you cut right through the noise. And finally, and maybe most importantly, always be aware of the big picture. Because that knowledge, that's what turns those overwhelming challenges into opportunities you can actually manage. And really, that's the bottom line here. It can all feel so overwhelming. But every single thing you learn, every concept you finally get, it's like another key in your hand. Financial literacy isn't just about spreadsheets and numbers. It's the tool that unlocks the door to your own financial future. So the only question left is, are you ready to turn the key?